Corporate finance practice problem using OneNote. Acquisition and earnings per share. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to. We're in the icon on the left-hand side. We're in the Practice Problems tab, down in the 2017 Acquisition and Earnings per Share tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will also be in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, information up top. We're going to go through the calculations on down below, looking at an acquisition type scenario. One company thinking of acquiring another company, scenario being B Corporation thinking of acquiring A Corporation. The information for B and A are as follows. Total earnings for A, 800,000, B, 4,200,000. Shares outstanding for A, 345,000, B, 2,200,000. Earnings per share, 2.3 for A, 1.9 for B. Price earnings ratio, 16 for A, 21 for B. And the market price per share, 36 for A, and for B, 40. We're going to say that the price will be a percent premium over the market value. So we're going to say the market value, remember B is basically acquiring A here. They're going to be paying 53% premium over the current market price of A, which is currently at the $36 per share. And when you're thinking about, of course, the price of the company as far as the market value goes, the shares are trading on the stock market. And if you just multiply the share price times the total shares outstanding, that's kind of the price that the market is determining is worth. Of course, when the purchase takes place, then they might have other things that are going to be involved that would be synergistic benefits or whatnot. So they might be paying, of course, higher than the current market price, and that could then affect what you would perceive the market price to be after the merger takes place, given the fact that that is indeed a market transaction between two entities. Okay, so we're going to say that if B issues shares to finance the purchase, how many shares would need to be issued? So we're going to assume that B is going to be financing the purchase through the issuance of shares. So once we know what the price is, we're going to have to determine how many shares B would then have to issue in order to pay for it. And we can use their price of the $40 in order to calculate that. So let's take a look at it. We got the price per share. We're going to say, all right, the stock price is at $36 per share. And again, $36 times the number of shares outstanding is kind of the base point where you would think would be the market's determination of the price. And you would think, again, the purchase could happen for something above that, given the benefits that could be involved if the two companies were to merge or acquisition was to take place. So they're going to be purchasing at a premium of 53% over the stock price. So the 36 times the 53% would give a 19.08 premium, and the price per share would be the 55.08. Just to calculate that a few different ways, obviously, we take 36 times the 0.53. That would be the premium plus the original price of the 36. That would be our 55.08. We can, of course, also say that if we had 100% plus the 0.53 premium, we would have 1.53 or 153% of times the price of 36, also getting us to the 55.08. Okay, so then we can think of the market value, which is going to be the price per share that we're going to be paying now, and we're going to multiply that times the 345,000 shares outstanding. Now note, this is kind of the market value because this is what we're considering the market in terms of this acquisition to take place. So the acquiring firm or the two firms in a market condition are settling. If they settle on this price, then that would be the price that has been kind of determined by the market, given this is basically a market transaction that's taking place here. So we're going to say, all right, that's going to be the 55.08 times the 345,000, and that'll give us our 19,2,600. Then we're going to calculate our price earnings ratio, so the price compared to the earnings. So the price per share is the 55.08. That's what we determined for our premium. The earnings per share is going to be the 2.3. So the price earnings ratio, price compared to the earnings per share, is going to then be the 55.08 divided by the 2.32, and that's going to give us our 23 23.74 about, or 23.75. There's rounding involved here. So then we got the new shares. So that means what are we going to have to issue then? What is B then going to have to issue in order to finance this operation, this transaction? So because they're going to issue stocks in order to do so. So the market value, once again, is that 19,006,000 or 2,600, and B's shares are currently on the market at $40. So if they can generate shares for $40 and distribute them for that $40, then we would say, well, how many new shares do they need to be putting out there then in order to meet that value of the 19,002,600 divided by 40? That would be 475,065 shares. And then we have the shares after the merger then. That means new shares are going to be out there. And when they issue new shares out there, that could be a little bit confusing, of course, because then now there's more shares out there. So you've got the merged earnings that took place, which could be good on an earnings per share level. But if they issued shares in order to make that happen, then you got to consider, okay, what's going to be the bottom line impact on the earnings per share and possibly on the PE or market price, PE ratio or market price. So we've got the starting point at the 2,200,000. That's how many shares we're starting. Then they're going to issue another 475,065. Adding those together, we're at 2,675,065 shares. Now we can look at the new earnings per share, given the fact that two things have now changed. One, the earnings would now be combined for the new companies, but also we have the new shares that are going to be that are out there. So we got the earnings for A, 800,000, earnings for B, the 4,200,000 from here. Adding those up, we got the total earnings of the 5 million. So that's the total earnings, which would be good on a per share basis to the stockholders. But then there's more shares out there. So now the total shares are at the 2,675,065 instead of what they were before, which was the 2,200,000. So if we divide that out, the 5 million divided by the 2,675,065, we then get to, let's do that in the calculator, 5 million divided by the 2,675,065 is going to be 1.87 about. So that's going to be the new earnings per share. And you can see the earnings per share is actually lower after this than it was before. So you got to, obviously, if they're going to issue new shares, you got to take into consideration those two factors. And then once we have the earnings per share, we can then think about, what the future earning potentials could be on it as well, and then see what the market does with regards to the price that they're going to assign to it, what's going to be the PE ratio that would be taking place at that point in time. Notice as we do go through these mergers, there's a lot more detail with the different types of mergers that we can dive into. We have an advanced financial accounting course that has a lot of stuff on mergers and different formats of the mergers and how they could be structured and whatnot. So if you want to look at that in more detail, take a look at that advanced financial accounting course.